In this section, I'm going to explain how we can use RSI, how to spot divergence, how to spot hidden divergence, and how we can identify possible entries with it. So RSI stands for Relative Strength Index. It's a momentum indicator that measures overbought and oversold conditions. Pretty similar to the Bollinger Bands, but it displays its data in a different visual way. So here's what it's going to look like if we zoom way in on it on a chart. Anything above 80, that green line right there, is considered overbought, and we can also see that goes out of the purple background. And then anything below 20, that red line, is considered oversold. So just like the Bollinger Bands, you can start to see the similarity between them. When price is overbought, when it's too high, we're looking for a sell. When price is too low, it's been oversold, we're going to look for a buy. So here in this example, you can see how price was oversold and bounced straight up from there. So again, if we're using other confirmations such as a Bollinger Band, just got another signal from the web analyzer, and I'll go over briefly that at the end of this. So you can see price was oversold. We took a buy entry and price went straight up. And in this example, we can see price is overbought and then went straight down from there, just like we would see in a Bollinger Band. All right, so next is divergence. There's two types of divergence we're gonna go over, and they both happen about as often as another. I wouldn't say one happens more than the other really. You just have to make sure you recognize whether it's hidden or regular. All right, so this is an example of regular divergence. So we can see on top when we're looking at the candlesticks, price is forming higher highs. When we look down the RSI, we see it's forming lower highs. So that means the price and the oscillator are diverging from each other, and that's where it gets its name from. You just want to spot when the chart and the oscillator or the RSI starts to disagree. We see the higher high form, and we see the lower high form. And then I scrolled out a little bit, we can see right after the divergence occurred, price started going down because the oscillator is giving us a sneak peek of where the momentum's going. It's showing us the momentum's going down, however, price is still going up. So that means we can actually pinpoint our entry on that. So when price formed that lower high in the RSI, or right where that arrow, that purple arrow begins, that's where we could have entered a sell position. We can see we've been very profitable going off that. You can also start to see how divergence is lining up with the overbought and oversold conditions that the Bollinger Band also had. So when we go over them at the end, you already have an idea of how they match with each other before you've even gone over it. Here's another example of regular divergence. We can see on top on the chart, price is forming lower lows, but on the oscillator, price is forming higher lows. And then we can see price shot up right after there. So again, we recognize that momentum is starting to be bullish. However, the price hasn't caught up to that. So we're getting a sneak peek about the upcoming trend on the oscillator. Lower low, higher low. You see how they're diverging from each other. All right, so the next type of divergence is called hidden divergence. Hidden divergence is very similar, just slightly different criteria. So on here, we see on the top, price is forming a higher low, and on the bottom, oscillator is forming a lower low. So it's essentially just the opposite of regular divergence. And we can see it's giving us a sneak peek that the trend is going to continue one more wave. So you can see price didn't collapse quite yet, but it did afterwards. So the difference between regular divergence and hidden divergence is regular is saying that the reversal is happening now. Hidden divergence says, hey, you have one more time for a buy before you sell. So hidden divergence gets its name because it's a little hit down more in the price data, and it's going to predict further into the future. So this one actually predicts the future more in advance than regular divergence because it's telling you there's one more wave up, you can get one more buy entry before you hit the reversal. Here's another example of hidden divergence. We can see a lower high forming, and here we see a higher high forming. Again, the exact same thing as regular divergence, it's just flip-flopped. Instead of having the lower low and the higher low, we're just having lower high and a higher high. And again, this one's telling us that we have one more opportunity to sell. Since this is a downtrend and we see the hidden divergence, we just have one more opportunity to take a sell position before we enter a buy position at the reversal. Boom. So that's it for RSI and divergence. And once I finish going over these slides, I'll answer any questions you guys have.